I'm not sure what meltdown the questioner is talking about, but if he's talking about the CDS's role in the financial crisis, I don't think CDSs were very central. That being said, after Dodd-Frank, there's a large amount of regulation that were shoved down the derivatives market, and anyone who is super pro-regulation should be very happy with this. But I think we have to be a little careful here. I mean, CDCs effectively act as substitute for credit ratings and usually are way better at it. So squashing this market presents a lot of risk. I mean, it's going to deprive, market actors who rely on this information. It will deprive them from this important information. So I think we have to be very careful for what we wish for. As for JPMorgan, I am baffled to see the level of public attention that the losses of a private company, commands. This is crazy. And in fact, I think the fact that the losses occurred through a credit default swap is totally irrelevant. This is a hedging bet that went poorly, and as we would expect for other company, the people responsible for it will be paying, and some of it, obviously, we know is already occurring. I think the chief investment officer at JPMorgan was dismissed, and I expect that more of this will happen. But more importantly, since when do we call for outlawing bad decisions made by the public sector? Like if a grocery store makes a decision that loses the grocery store a lot of money, we don't have congressional hearings. It just really actually, I think, calls on the very unhealthy relationship between the financial industry and the government. And I certainly believe that having more regulators, having more bureaucrats tracking down every movement by JPMorgan is certainly not going to prevent them from losing more of their own money. But it's actually probably going to cost taxpayers a lot of money for something that's perfectly pointless.